We are live. Welcome to Soar Financially. Welcome to a channel where we discuss the macro to understand the micro. My name is Kai Hoffman. I'm the JR mining guy over on Next, and of course, you're a host of this channel. Really appreciate you joining us for a live interview and live Q&A session. We haven't done one of those in a while, so please let us know if the audio is fine and everything as well. You got a comment section or the live chat that you can use. So let us know how are things going. Can you hear us? Okay, love to hear from you. I said it's like live interview, live Q&A session. Our guest today is Christian Vartian. He's a portfolio builder over at GIP AG. He's Austrian, right, Christian? Austrian?
Yes, I'm Austrian, yeah.
Austrian, right? And really excited to have him join us because his calls have been spot on. He is a fan favorite on the channel, and we'll reiterate some of his calls that he made at the DEUTSCHE GOLDMESSE last November, because he was spot on. That's why, like, his track record is impeccable. And Christian emailed me last week, said, Kai, I got to come back on the program. Things are changing. The charts are talking to me here. Let's record another episode. Pat ourselves a little bit on the back, but also warn investors about what is to come here and to dissect that. I'll switch over to my guest in just a short second. A quick reminder, hit that like and subscribe button. It helps us out tremendously. We do appreciate it. We're awfully close to 50,000 subscribers. A number, I don't know, it's a milestone number for me. I'm really excited about it. So thank you so much for your support. It is much appreciated. Now, let me bring Christian on. And Christian, thank you so much for joining us again here for a live interview and Q&A session. Thank you so much.
No, hello. Good evening to everybody, and thanks for having me. Indeed, at the Gold Show, we made a larger, I think it was a podium discussion, you did actually force me to make a call of a gold price target. And the first news we have to discuss is we're there. Everybody can check it. I mean, just go to your channel, see the keynote, and you're going to see it between the minute 19 and 20. And the 2,843 out of own traction in the gold price has been reached. And as of now, we are somehow like a sailing boat following the wind because we have been there based on our engine. Okay, so sorry for doing that, but our system of analyzing is pretty different from others. And based on engine, steam, we have reached the 2,843. And until we might reach the 3,030, we are a sailboat now.
Just waiting for the wind to blow and give us direction, correct?
Yes.
Okay. Before we dive deeper, because you brought us some charts as well, Christian. Let's take a step back, perhaps. Let's explain what took us to 28.43, your call, and pushed us to above or to right around $2,900 right now. We spoke in November. Our conference was around November 20th. What has changed since, and what has given us some extra fuel, perhaps, to get us to the 28.43, and what pushed us past that line as well?
No, honestly, there was no extra fuel needed. If it's in the physical power geometry, which we can measure, then it's gonna go there. So there was no fuel needed. Actually, there was not much fuel happening from exterior. And I mean, I'm pretty conservative on giving calls, but the call was 2,843 own drive, by own means, by own engine, and we reached it. Okay. As usually, using such a method doesn't mean that the price thereafter is frozen at 2,843. But it's like in northern Canada, and you have an icy road, and the traction is over. You may glitter far more miles, but you won't do that on your own steam, right? And so gold drivers are actually pretty negative still. So there would be room to move from the driver's side, room to move much more to the upside. I mean, calculatory room to move from the driver's side is more than $3,000, far more. But it's not in the physical energy yet. So I'm trying to report your physical energy, and I can state and quote other indicators that we have, like I say it again, correlation drivers. The correlation drivers would actually point to something higher because they are very, very negative for gold still. So we did achieve the 2843 against the wind, with headwind, not with tailwind. Okay. Then we had 2 days of a little tailwind. We almost broke $3,000, but tailwind actually ceased, and we fell back to 2870, 2880, which is typical for such an icy road on which you are driven by the wind only. So that's the
We just
situation as of now.
But like gold is waiting for an impulse, right? So we're focused on gold right now. So it's just like sitting on a lake that has no wind, right? It's sitting in the middle of a lake. It's reached its target. There's no wind blowing right now, and it's waiting for a direction,
But
right?
there is a
Is that
little bit. There is a little bit of wind which blew it to 2940 or so, 2950, and then the headwind came back and it blew it back to like 2880, and now we are 2900 or something. But we have to expect that these winds will prevail until we will reach the other side of the lake, or the side we came from, which would be under 2840 basically, or the other side of the lake, which is a little bit over 3,000. And before, we're not going to be on ground. We're going to be on ice. That's the only message I can give you. I could tell you 30 minutes before what gold is going to do. This I know. But I can't forecast it like that because the wind is a short time stuff.
No.
The traction
Now
is not.
you told me though before we went live here is that you're sensing that there's more room to the upside, that the wind is probably more blowing from behind the gold price and pushing it potentially higher than it is more of a headwind. It's more of a tailwind than a headwind. Can you elaborate on that? Like why are you slightly more positive than
Now,
negative?
there is two factors in that. The first thing is that if you remember our older, I mean, not from November 2024, but older than that. I think it's a year old or even 2 years. I don't remember actually, but it was actually on your show where I said that the silver price is gonna break the downward trend line to the upside. If I remember correctly, this was either 2022 or 2023. Now it decisively did so, and but we have a same calculation as we had for gold for the silver price, and that would give us an target under steam, so by own means, by own engine, of $43, and we are far away from it. And since gold and silver are not 100% correlated at all, but neither they are uncorrelated, so they move a little bit together, one another. That would be an indication, actually, that the movement in gold would be more to the upwards because the movement in silver is still due to the upwards. That's measurable. In gold, it's not measurable in the moment, but silver should move up heavily, by the way, about $11 from the actual price. And it didn't do so yet. And I wouldn't see many scenarios, actually, where silver would move up $11 while gold would sink. It's normally not sinking when silver moves. It might move differently, much lower, much less, or much more. But normally, it should not go down when silver would make such a move up.
No, interesting. Like maybe we'll dissect silver in a second. I just want to stay on gold for a bit longer because it seems like mainstream media is picking up gold as well. Like I just read an article this morning, the Financial Times, that gold is the #1 Trump trade right now. UBS, Citigroup upgraded their price targets to like $3,000. Question is like, is gold overbought, and is maybe the gold market overcrowded already, or the
No,
gold
I
trade,
wouldn't say
not the
that.
gold market? Sorry.
Okay. No, overbought, it's certainly not. We do not have a precious metals boom, as you can see in the platinum price. So it's under $1,000 as we speak. It may be under. Look, what's actually happening is China doesn't buy gold. Even that in the media, you will find a lot of news that China is buying gold. But those news do not mention that China is the biggest producer of gold. So what China is doing is actually not selling gold. And that creates a scarcity on the demand, on the supply side. And this helps the gold price. Yet you can't describe that as overbought. Because what's happening is that the Chinese state is buying it from the Chinese mines. Therefore, the Chinese mines do not put that quantity to the market. Okay? But it doesn't mean that the normal investors, funds, whatever investment funds, would be overinvested in gold. They're not at all. So there's much room to move. Because what happened is just that the biggest gold producer in the world, China, didn't deliver so much gold to the market because the own government, the Chinese government, bought it directly, if you want, over the counter from the mines. So the public, which normally would buy gold, is not overinvested at all.
So the Chinese retail investor hasn't shifted or hasn't, made additional purchases, or the Chinese central bank has pushed prices higher. It's really just different factors that, like you're mentioning. I just really want to hone down on that because that could be quite controversial, because it's central bank buying in general that's been pushing gold higher. But you're saying it's not really the Chinese central banks or China itself buying, correct?
No, what I'm saying is that there's just because the Chinese government, including its central bank, is adding to its gold reserves, that's enough for creating less supply on the market, which helped to drive the price up. But let's say, if a gold price rise happens that way, it is quite different than it would happen because investors would be overfed with gold. They're not, because they didn't buy it. Somebody else bought it, and the result was not that the market was overbought, but the supply was drawn out. This is what happened, okay? So there was just less gold coming to the market. Less supply creates higher prices too. You do not always need to have more demand, right? As we see in the US data, by the way, but we'll talk that later, I think.
Yeah. Break down the supply side for gold, because I looked at the gold report, or the World Gold Council gold report, and just looking at mine production, it's pretty much flat. I think we're up like 1% or so year over year. Why you say supply is short? Like, what do you mean by that? Can you elaborate a little bit?
It's very simple. If a certain amount of Chinese mine supply normally goes to the market, and the market makes prices, and now it doesn't go to the market, but it goes to the own government in an OTC deal, then you shorten the supply. Shorten the supply always means that you shorten the supply compared as to how the supply was before. So if a mine stops to sell to the market and sells to the own government, the price reduction of that supply coming to the market disappears. This is what happens. But it doesn't mean at all that normal gold buyers would be overfed with gold, because they didn't buy it. You understand me? It's not a problem of buying. It's a problem that just somebody drains the demand because he buys directly from its own mines. And that makes the first difference to silver, where the biggest producer is, as we all know, Mexico, and not China. Right? And Mexico does not collect silver. The Mexican government is not collecting silver, but the Chinese government is collecting gold.
And silver to a degree. Like, it doesn't export any precious metals, China does. So, on the topic of hype and demand potentially, like Scott Bessent mentioned that he wants to, of course, monetize the U.S. assets, and we have to talk about gold. It's the same trade almost as with Bitcoin. And I don't want to mix the two really, but it seems like there's the same hype going on about gold that we've seen about Bitcoin that pushed Bitcoin to 100,000 when people expected that the U.S. government would create a Bitcoin reserve. Now there seems to be rumor that the U.S. might be revaluing gold or even issue a 50-year bond that could potentially be backed by gold. Like, what do you make of that? Like, how much of that hype is priced in right now?
Almost nothing.
Okay.
Almost nothing. Sorry,
Yeah.
nothing. The typical metal when you get psychological problems with the United States dollar or its backing or the backing of US debt has always been platinum, and there happens absolutely nothing.
Okay. I've seen a few questions about platinum in the chat, so let's elaborate on that topic. Like, why is platinum more important or reacts more than gold here? Like, let's explain that.
Because theoretically, the United States could issue money based on platinum. This is, let's say, a loophole in the actual legal and constitutional framework. And you might remember that I think it was in 2009, then President Obama said he's not going to do it. But there was even speculations that they could, because they cannot do that on gold and silver, but they could do it on platinum. It's an old loophole. And classically, platinum is moving up in case you start to discuss these questions. The gold price issue is, in my opinion, connected to something totally different. And I did make a short chart, which you will find. It's a double chart. It's a photo of two charts, actually. I don't know if you want to.
Yeah, yeah. Let me just know if it's the right
one. It's not that one. That's a ratio. It's that one, the double one.
That one. Yeah. Here we
the
go.
double. The double. There's two charts on one. Not this one. The double.
This one. Oh, there we go. Sorry, that's the one.
This one,
right?
Exactly.
Yeah.
So, and what you see here is pretty simple. I made a short-term one just for our listeners to have the chance to understand the driver dynamics. Okay. What you see on the upper part is the price of the 10-year Treasury. And what you see on the lower part is the gold price. So, and in the moment, not always, but in the moment, you see a negative correlation. So why is that? Because we mentioned before, not only the Chinese government, but other holders of big reserves had to actually, because of diverse political or other reasons, diversify from treasuries into something else. Okay? So gold did actually not replace the dollar, which is a nonsense anyway, but for a lot of reserve liquidity, it obviously replaced the 10-year Treasury. And this is the biggest risk for gold in the moment, because a part of the money that is in gold in the moment is tourist money, so to speak, which normally would have been in treasuries if their performance would not have been so catastrophic as it was since 2021, because they actually sank and sank and sank because the yields went higher, so the price went lower, right? And just start with the negative side. The risk is here. Now, in case, let's say, treasuries would recover, they are far from recovering. They're just somewhere out of the grave in the moment. This would certainly cause a part of the money parked in gold to want to go back home into treasuries. This is also valid for, in case there is no political conflict, of course, in case there is no duties, in case there is no tariffs, in many cases, basically, for the government of the biggest industrial power on the planet, which is the People's Republic of China, which then would maybe also buy treasuries again, which they don't. They actually sell them slowly, but they sell. and therefore would invest less in gold. Okay, so this is the biggest risk, that we have to understand that gold actually, besides its normal customers, its normal holders, attracted tourists who fled the treasury markets for diverse reasons. And a part of the money in gold might go back to what they would like to be, in case they could safely be there and get their 4% interest.
I was going to ask, like, is there a threshold price where you think money starts to accelerate moving out of gold? Is there like a 5%? Is it 5.5%? Do you have an idea of where that price level might be, or that coupon level?
Not really. The point is, if you think reasonably, let's imagine you have trillions to park, and you would be in the situation that you don't trust the counterparty, or you are sanctioned that you can't invest in a counterparty's asset. But then you have to choose something which has no counterparty, and the only thing on the planet which is known to everybody, which has no counterparty, is gold. Gold doesn't need a counterparty, so it's not a claim. Okay, a treasury is a claim. It's just a claim. It's nothing else. But gold is a thing. It's not a claim. And what we saw actually is moving a lot of money, instead of into treasuries, into a non-claim, a thing, which is gold. Yet, scenarios do not happen ceteris paribus, okay? Scenarios happen in a context. And it might well be, and that's actually what our indicators are saying, that a bull market in treasuries would actually result in a bear market for stocks. Because in stocks is much more tourist money, which normally would be in treasuries, than tourist money in gold. And now, in case that would happen, even outflowing money out of gold could be compensated by inflowing money into gold, but the inflowing money would be from stocks. So things happen in a context. It is pretty sure that if treasury prices recover, that means yields go down, gold is going to lose money to the treasuries just in the same moment. If yields go down and treasury prices go up, the stock market is also going to lose money. And if the stock market is getting more bearish, that might even cause more money flowing from stock market into gold than gold would lose to the bond market. I know it's complicated, but it's the reality. We measure it.
It's just a flow of funds and liquidity. It's pretty straightforward. You know, it's like if you can make easy money in the S&P 500, like easy money meaning almost risk-free, like we talked about this on our channel before. Like over the last, 15 years, only 3 years have been down years. Maybe 4 years, sorry, because I keep excluding the one where the down year in the S&P 500 was 0.5%, so I don't really count that.
Yeah.
But other than that, like it's been up 20% pretty much every year, right? So that tourist money is in there that used to be potentially in bonds that is now in the S&P 500. That's what you're saying, right? And I'm just trying to summarize it for everybody to understand.
Yeah, that's what I'm saying. And there is also tourist money from bonds in gold, but lesser than in stocks. And so if you talk about gold prices, a price is decided by what happens at the same time. So yes, gold, in case treasuries recover, gold is going to lose money to the treasuries, but at the same moment might gain more money from stocks than it's losing to treasuries.
No, that makes sense. That makes sense. The question now is, like, when do we see a bigger rotation of money? Like, apparently there's a lot of money sitting also in money market funds, just harvesting returns, but it's not rotating yet. It hasn't really started to move yet. Have you seen anything like in that regard? Have you seen it start moving yet? Or like, what are you watching for? Or what's an indicator you're looking for to track the flow of funds here, the flow of money?
No, the flow of money, we have pretty proprietary indicators who can actually measure that in a pretty precise way. But the most important thing to understand is that what you call the core of the financial system in the world, which is actually the US and at the lesser grade, the European Union, had the privilege of attracting money, and other regions of the planet, I mean, except India, had an outflow of money like China. And now I brought a second chart. That would actually be the one with the Chinese stock index. That's the Hang Seng somewhere. It's not that one.
No, no. There we go.
This is a ratio chart. Yes. Okay. So that shows you the Hang Seng. Now, it's pretty funny because we're gonna see a silver chart later on. And the Hang Seng is trying. It's trying to come out of the bottom of its bear market. Now, we also have to remember that it's the biggest industrial power in the world, so it's consuming the most commodities. It's also consuming the most metals. If we talk now about metal consumption, not investing, right? And if you look at that, I mean, this is a pretty sticky situation, right? And this pretty sticky situation, it's actually prepared for a breakdown or a breakout. If rather on the breakout side, but everybody who understands chart technique, doesn't matter which one, will say it's not speaking yet. Because what you want to speak when you see a chart like that, with a 5 times top at the same level, yet you have lows which are slightly increasing. So it speaks more to the upside than to the downside, and it's very cheap. I mean, those stocks are incredibly cheap compared to US valuations. If I could have a silver chart, it's going to explain.
There it is.
This, yes, exactly. So now we see that at the same time, silver tries and tries and tries and tries to break a certain 32, 34 top, right? In order to finally come home to $43 as I computed. And it pretty much looks a little bit more bullish than the Hang Seng. But you see it's moving up with the Hang Seng. From the impulse side, it's pretty much related to China, which is totally logical. It's also an industrial metal, more than gold. And you have to get an industry out of recession first. And this is what China was in. For Chinese means it was a recession, okay? And then I think we're going to blow through that top and reach the 43, and then we see what's going to happen later on. But fact of the matter is, if either of these charts, and silver and the Hang Seng, are going to do it together or not, I'm pretty sure about that. If either of these charts breaks to the upside, in silver I have a computed target of $43, then I think gold will glitter on its ice lake towards the 3,000, because it has almost no chance to do otherwise.
Christian, I think I've asked you this before, and I think you're going to laugh at me for asking it again, but the gold-silver ratio, how important is that to you, Christian? And is it even a factor?
I brought the chart for it. It's the last chart, I think.
Nice setup. There you go, isn't that?
Yes,
yeah,
I thought you were going to ask me that.
Here, let me bring that on the screen here real quick. I had to. You just gave me an easy layup.
Yeah, here it is. Fantastic. I don't know what to do. 89 stuff. No, first of all, I don't believe in that ratio saying anything. I was the biggest enemy of people trying to read anything out of that ratio. Okay, because they argued first the ratio was 50, and that's the traditional ratio, and that's why the COMEX actually made a silver future 5,000 ounces and the gold future 100 ounces, which would be 1:50, which might have been in the past a kind of correlation median, or whatever you want to call it, a many-year average. But the fact of the matter is the the correlation, the ratio was about 40 at the last big silver top in 2011. So it wasn't 50 there either. And now we are around 90. I don't think that 90 is exaggerated. I'm using that chart not for giving the gold silver ratio any meaning, but for seeing if it breaks out. So I wouldn't care if it breaks out at 35 or at 90, but I want to see if it breaks out, because it shows you something about conservative and more offensive, right? And in case we would get a precious metal boom, it should actually break down, because that's a gold silver ratio. So it should break down. Silver should rise against gold, right? And as we see, it doesn't yet. Neither does it break down. So we have reached, so to speak, a kind of average of magnetism. Gold still being the reserve asset, silver still being on the weight, but with the nose up, somehow wanting to reach its $43, not really achieving yet. But the chart actually shows you, doesn't matter. Again, the level doesn't matter. 89 means nothing. 50 means nothing. 40 means nothing. It means nothing. But the trend on the chart means something. Because if you get a precious metals boom, that chart should go down. And it doesn't yet.
Yeah. Well, based on your price... Oh, sorry. But based on your price predictions of $43 silver and about 3,030 for gold, then, of course, the gold-silver ratio has to break down, meaning like it has to go lower.
Absolutely. It has to go lower. We have another gold target, but this is not provided yet by physical geometry. That would be north of 3,300. It might fit to that. But this I want to see, because it could be with outflows of American stocks. That could be a possibility of having silver 43 and gold 3,300. But I'm pretty doubtful because of the chart I showed before on the negative correlation with bonds. And the recession would actually put some of the gold money into bonds. So there's not enough left, in my opinion, right now, for reaching 3,300. You know what I mean? It's a lot. 3,030, yes. 3,030 is something else. But 3,300 is a lot. So I think that the next wave, if it's really a metals wave, should actually show us that chart going down, so silver actually rising against gold. If not, there is the only possibility I just said. That would be the end of recession in China and the recession in the US. That would actually enable so much gold rise as the silver rise would need to be, not changing the correlation.
Before we get to the U.S. in specific, I want to talk to you about Fed policy, deflation, recession, like we touched on just before hitting the record and go live button here. But we got a couple questions from the audience. Maybe a couple questions also to clarify some of your statements. And maybe I'll start with David Jackson has been asking, is your guest bullish or bearish on gold? It sounds like he's bullish, and in other statements he's bearish. So maybe just to summarize before we move on topics here, Christian. Are you bullish or bearish on gold?
It's a little bit difficult question if I told you we are there. I mean, I was bullish on gold. It was a full hit. It was spot on. And now we are there. Giving all the factors together, it looks like the upward chance is a little bit higher than the downward chance. And I did really explain it in detail. We're going to lose money against bonds. We're going to gain money from stocks. The question is how much and what happens first. Okay. That's the answer to it.
Yeah, no, it's like I also ask it just to summarize, because we've been chatting for about 30, 35 minutes almost. So I just wanted to summarize your points as well. So before we move on to a different topic. But there's one more question. Mr. Tischler is asking, to what extent is the central bank money rotating out of treasuries into gold? It's a bit a different spin on what we've discussed earlier.
To a small extent, because most of the money rotating into gold is new money. Please don't forget that we're talking about surplus states. Surplus states, which have a trade surplus, they're accumulating new reserves every month. And what they actually do in the moment, they buy only gold and no treasuries. So you can't call that out of treasuries, because that doesn't mean that they sell them. It just means that from fresh additional new money, they buy only gold.
Makes sense. Makes sense. No, Christian, thank you so much. Just double checking here the questions we got in that fit in. Like, there's a question about the euro I'll ask later. Please put your questions just down here. So we really appreciate that. But Christian, let's move to the US real quick. Let's talk about Fed policy. We talked about deflation and tariff impacts before hitting the record button here. I think we need to break that down just a little bit. What's the US economy or the situation in the US right now on the economic side?
I mean, if I'm just reading data and start to make a 6-year-old child computing, I'm reading retail sales last month minus 0.9%, but CPI plus 0.4. And if I make a slight simplification and I add the two numbers, I come to the fact that 1.3% less merchandise was sold in a month. In a year, that's 15%. I wouldn't call that bullish. I don't hear you, sorry.
Apologize, I was coughing and I
problem.
muted myself.
Yes, good. Yeah.
No, I was asking, but how's the market reacting to it? It seems like it's ignoring the news for now, and the Fed is ignoring certain trends as well. So it's like, how do we make sense of this? Like, why is nobody reacting to that, Christian?
I have no idea why they're not reacting to it. Maybe that basic alpha feeds are running on the nominal and not on the quantitative. But 0.9% less spent with a price increase of 4% is 1.3% less sold. Sorry. And if somebody puts that into an equation and multiplies by 12, he's going to get a pretty alarming signal. Anyway, it shows something else for sure. And this is if the narrative of demand side and that means money side driven price increases would be correct, such data would be impossible. So if the demand is driving prices up because there is too much money, which would be inflation in a correct sense of the word, such data would be impossible. So if you sell 0.9% less with a price increase of 0.4%, it actually means that it's a scarcity price increase. Sorry, that's the supply side. It's not the demand side. And the supply side price increases are not inflation. They are called scarcity. Nothing else.
Which you can easily fix, correct?
Yeah, it's not so easy to fix because you have to produce more or import more. So it's actually not so easy to fix. And especially the Fed should recognize that such a kind of price increase cannot be fixed by monetary policy. And if by reducing interest rates, because interest rates, medium term, are influencing costs of production. So lower interest rates would make products cheaper. So they completely ignore that second side of interest rates, that they are cost factor. And if we're going to see data like that for several months continuously, which we might see, and the Fed doesn't react, that's not going to end up very funnily.
We got a question in earlier, which fits in quite well here, and it's from Frank Rill, and he's asking, when do you expect the ending of QT? And that's sort of what you're touching on, like, it sort of fits what you've been discussing. Like, we need to loosen monetary policy, potentially, although monetary policy doesn't seem to fix the problem. But there is an underlying tone that sort of fits what you just said. Like, maybe we can elaborate on that.
Look, I have no prediction on what the Fed does, because what they actually do is following a certain economic theory, which is now about 35 years in place and which is totally wrong. And it's not my fault that it's wrong, but it's wrong. But it thinks that everything is demand side driven. So if people have too much money, if there is low interest rates, then prices go up, and if there is high interest rates, prices go down. This is actually what they tell you in basically every media, including the Fed's chairman. But in reality, that might be correct, but only under certain circumstances. And nobody is discussing the parameters if we are in a circumstance where this is correct. And according to not only my opinion, we are not in circumstances in which this is correct. So every economic theory is based on an axiomatic baselines, and if they are not valid, then the theory is not functioning. There's nothing else than that to say.
Christian, you wrote in one of your newsletters, you write that interest rates are way too high. Where should they be?
First of all, the bigger problem is the quantity of money. So one has to imagine that if we would have scientifically more skillful people, they would at least imagine a possibility of high interest and QE. I know that the last 35 years, nobody was ever thinking about high interest rates and QE because they always thought about interest rates must be restrictive if the quantitative policy is also restrictive. And nobody ever thought about one being restrictive, whereas the other one is not restrictive. So in the moment with the theory drivers in place in the heads of the Fed officials, if they continue to work like that, a proper interest rate set is around 2 to 2.5%. I say if you want to continue to use that relatively wrong economic theory. If you would instead follow the ideas and goals of the US president and come back to more sophisticated theories, you could well have interest rates around 4%, but that should be actually joined with QE. That means you would have an expensive monetary quantity at relatively high prices. This has been done 40, 50 years ago. It can be done, and it would have a sorting function. Let me just explain a second that people understand because it's so old. What is a sorting function? Imagine you can get plenty of money, plenty, because there's QE, but the money is expensive. And that means the money would actually engage in more productive sectors. If you can get plenty of money, but at high prices, at high interest rates, you would encourage productive sectors. And it would be a horror for real estate, honestly speaking. But nobody dares to do that because it would actually kill real estate in favor of manufacturing. And that's why they don't do it. Even that it could be a way to, for example, achieve the goals of the US president. Just the goals of the US president might not be his goals as an entrepreneur because he's a real estate entrepreneur. You understand what I mean? Because what can a condo or a personal house produce? They produce nothing, produce living space. And if you would invest, let's say, in an innovative industry, money could bear much higher interest rates there because there's a growth factor than it can in real estate. And that's why actually they refrain from doing that, therefore neglecting the older and better theories. So they will do it. They will do it. Higher interest rate is QT, lower interest rate is QE. And if they want to do it like that, then the interest rate is much too high. So it should be around 2% before it hits everybody.
I have to ask you a very cheesy question here, Christian. I'm almost embarrassed to ask, but is the U.S. in a recession right now?
Oh, partly. The US is certainly partly in a recession with certain sectors, and partly it's still in a boom with other sectors. You see that on the data. Pretty simple. You got an incredible growth in the IT and artificial intelligence industry, and you must have a kind of recession somewhere else. Otherwise, you couldn't have that official data. It just doesn't add up. Yeah.
Makes sense. It makes sense. No, I appreciate that, Christian. I have one last topic I want to tackle with you before we get to a proper Q&A session. I want to encourage everybody to put some questions in the chat. I'm bookmarking them here to ask during our Q&A session when they fit in. But put them in the chat here, and we'll get to those. Christian and I, we're going to discuss the US dollar real quick, because everything we just discussed is going to have some massive implication in the US dollar, especially if you flood the market with cash or money. Christian, what are your thoughts on the US dollar? Is it too strong? Is it too weak? And where do you think it will be trending?
It is certainly too expensive compared to Asian currencies in the moment. I wouldn't say it's overvalued against the euro. I wouldn't say that. But again, I would like to really decrease the emphasis on that topic, because what matters is the 10-year Treasury and not the dollar. I'm sorry to say that again and again and again. In case you need to place billions of cash, you will never do it at the bank, because you will be richer than the bank. And if the bank breaks down, your money will be gone, except the one which is insured, which is basically nothing. So holding money, especially in US dollar, means holding treasuries. And you might follow Warren Buffett on that, who I think was not perfect in his timing to increase his cash levels. But he actually didn't put it to bank accounts. He put it to money market kind of short-term bonds and treasuries. So please understand that if you look to the chart of the treasuries, of the US treasuries, you see the problem of the American currency. I doubt that you will see it in the X rate of the dollar. The X rate of the dollar does not matter compared to the treasury price, because all big fortunes, all big reserves are held in treasuries, not in dollar cash at bank accounts.
No, Christian, thank you so much for clarifying that. And maybe we'll jump into our Q&A session, because I got a different question that fits in as a good follow-up. It has been spelled out or written in German. So let me translate it real quick. But it says, hello Christian, or hello Herr Vartian. What do you think of the euro? How much longer will it hold? And how much longer will the EU hold? We don't need to get political here, but let's talk about the euro and maybe the euro, the union of the euro. I'm curious what your thoughts are.
No, latest news suggests that Germany gets same problematic like the other countries in the Eurozone, which actually will stabilize the euro. Because if the strongest one gets weaker, he's getting more normal and less likely to step out. So it's a negative, positive prediction for the euro, because Germany is getting weaker industrially and at a fast pace. So that means that nobody will realistically think about stepping out of the euro. And whatever you mean or you appreciate the euro, it's going to hold longer at a lower level, but longer. Gotcha. If you ask me.
Yeah. No, it's like we often talk about the US dollar. We rarely talk about the euro and how it fits in, because it feels like we're being ignored here in Europe anyway on a global scale. We've just seen that at the Munich Security Conference, or not just around the Munich Security Conference, where US and Russia are negotiating a deal for the Ukraine, and the EU hasn't even been invited to the conversation, right? It feels like the same on the currency side. Like, how relevant is the euro still? Curious what your thoughts are. I know, more theoretical question than practical.
No, irrelevant it is, because it is actually the biggest currency on the planet. If you don't talk reserve or international use, but if you talk about national use, and you still will find out that most commodity prices correlate the most with the euro. So the euro is bigger than the dollar when you talk about daily purchase and sale. Just as a reserve currency, I really do not think that it's pretty much something interesting. And I'm absolutely not wondering, by the way, that the United States and the Russian Federation try to reestablish what is the best of their relation, and that's economics. Because those two countries do not deliver things which the other one has. So it's a perfect economic fit. I always said that years and years and years, Russia and America are perfect economic fit. And they will always try to get that fit back. It's wonderful if you can sell American V8 V8 cars to the Russian Federation, and they pay you in oil, and there's no competitor, there's no jobs lost on that. So their economic cooperation, if you look to the structure of the merchandise, is perfect. And it's normal that over time, businessmen on both sides try to get back what fits so well. This is just the money driver that I see behind, not mentioning politics. I don't want to talk about politics, but you see, you fit. It's fitting. It's wonderful. It's so wonderful. Yeah? If we just could make trade, I don't sell you anything. I don't make a competition. No, they fit together economically. That's, I think, what they are missing. I don't think that they like each other now, but they miss the perfect trade partner.
No, it's just on the commodity side alone. You mentioned oil, gas, platinum, palladium, and many other metals, for example, as well. We got about 5 more minutes here, Christian, and I'll have a couple more random questions. Like they don't really fit in, but I think they're fitting to the topic, and I know we've talked about it before. Let me bring that on screen here. One question we have here. Do you have a view on the GDX or GDXJ here, Christian? Like in terms of like just mining stocks. I know we talked about it before. I know you follow some of the bigger names, like a First Majestic. I know you follow, just to pick one because you mentioned it to me. But like, what are your thoughts?
My thoughts are pretty simple, and I could be followed and with real time calls in the last 2 3 years on them, and I actually said they're gonna go up, but not a lot, and that's what they did. They are gonna start to really move once silver breaks out, not before.
Yeah,
So
you
they have,
mentioned
not,
that.
they have no correlation with gold as a reserve asset instead of treasuries. That function of gold does not help mines.
No, you mentioned that at the Deutsche Goldmesse as well before. So in that almost verbatim, you repeated yourself there. So good. No, appreciate that, Christian. One more question we have here. We talked about central banks and central banks buying gold. Mr. Tischler is asking a follow-up question. Do you have an opinion on the quantity of new central bank money coming into the gold market?
Now, interestingly, a lot, because in order to have new central bank money, we're talking about new. I emphasize on that word new. You normally have to either do a QE or be a surplus country, either or. And the fact is that the surplus countries, which have trade surpluses, are heavily buying gold. So, yes, on the new money, yes. On the old money, it's very little. It's a little bit of distribution. But the new money goes heavily in gold.
Gotcha. No, that's a good question though. Poland has been the biggest buyer of gold of all the central banks, and nobody really talks about it. Only few people know that fact, and it's not a secret or anything. It's just not really talked about because China seems to be dominating the headlines, and nobody cares about the rest. It seems like so. It is really interesting.
You mean Poland?
Poland, yeah, they're the biggest
You know
buyer
that
of gold.
they're also the biggest buyer of weapons.
Probably they have to, like quite
They
honestly,
buy
but that's a
tanks like
different
hell from South
conversation.
Korea. They buy South Korean tanks like hell.
Yeah.
So Poland has a certain political attitude, and it looks pretty much to the pessimistic side. That's why they do both of it.
Yeah. No, they know what's coming probably, but that's again different discussion. We had Colonel McGregor on the channel just yesterday. yesterday. We uploaded the video, so go check that out here on the channel as well. Christian, maybe I've saved the biggest question for last, and I don't know why I've asked it sooner, but is there a gold squeeze happening right now? And how much is that influencing the gold price? Maybe as a last question to our conversation here.
No, I don't see a gold squeeze again. If we would see all of those things, a gold squeeze, positive drivers, we would be 3,300 and more. We're far away from that. We're really far away from that. Gold is actually going up against the wind because of its own drive, and it did so without a precious metal boom, without a mining stock boom, just alone, because it is not a counterparty. It's just a thing. And in a world where nobody trusts the other one and nobody trusts the government, reserve holders moved more to the thing than to, let's say, a bilaterally accepted reserve stuff, which is interest-bearing, which is a receivable. Plus, this was one factor. The second factor was, that the bonds, especially U.S. Treasuries, did crash in price since 2021. It was a heavy price crash. So also just for pure price reasons, gold went up, treasuries went down. Why would you hold treasuries if gold goes up and treasuries go down? But it actually moved on the left foot. I just want to say that all the time. It moved on the left foot without being in a bull market as such. Also, Bitcoin did the same. Bitcoin is up and the other coins are not. Okay? So this is like, it's placeholder buying. Central banks or governments are talking about buying Bitcoin reserves. But that's instead of bonds. Okay? Bitcoin instead of bonds. Gold instead of bonds. That's what we're talking here. This is why let's say the Bitcoin to Dash ratio is so explosively high and dramatically somewhere else than it was in 2017. Okay? They just buy the big one.
And gold is
the
the
boom
big
didn't
dog.
start. The precious metals boom didn't start yet. There is none. Otherwise, we would have silver $60. Okay?
Yeah. Fantastic. Christian, wonderful conversation. Really, really appreciate your time. Really thank everybody for the comments. Like, the chat has been super active and super busy. It has been fun to monitor. And no, I do not dye my hair. I don't have to yet, fortunately. I really appreciate everybody tuning in. Like, it's a lot of fun. I think we should do this more often. We have a ton of videos coming up on our channel in the next 30 days. So make sure to check that out. And Christian, where can we follow more of your work?
But actually on your channel. I did actually cancel my webpage because I didn't want to have simplistic requests for work. I want to do what I'm doing, what we just did together. You can read me on Goldseiten every Sunday, but I don't want to simplify things. In order to do my work correctly, and you are a witness that we did it even together at gold shows, and we made calls that actually were spot on later on. I want to be as complicated as needed, not as I want. I don't like to be complicated, but I want to be as complicated as needed and not getting simple stupid, so to speak, extremely brutally, but keep it simple stupid is not an option for me. So on qualified media, like on yours, you can follow me or you can write me an email if you want to be a client. But we don't do simple things. We do complex portfolios. We do cross correlations. We have extremely sophisticated indicators. I'm sorry that we don't do it more simply, and I'm not going to start to do it. I'm pretty hard-headed on that. Anyway, thanks for having me, and I hope that my short, let's say, my input is that in the moment gold is on a frozen Canadian lake running with the wind. This is not an alarm signal, but it should say to people that it's not automatically going to the 3,000 from now. Okay, so we should wait. It might well jump much over 3,000, but we have to be careful because things are without own steam. in the moment.
Fantastic. Christian, thank you so much. Really, really appreciate it. Everybody else, thank you so much for tuning in. This was a blast. We'll be back with lots more. Thank you so much. Take care.
Thank you.